afternoon, everybody. I'm Susanna Streeter and welcome back to the MoneyLIVE Autumn Festival, the big meetup. It's great to have you with us, to see so many delegates at the conference today, 350 from the world of payments. So it's really great to see you all here. So we are going to begin this session now, where we are really talking about the topic of lending innovation. So much innovation in this space, to buy now, pay later, of course, digital mortgages, and also we're going to be exploring the future of credit risk and enhancing financial well-being for customers. So lots to talk about, and I'm really glad to say we have a lot of representatives from companies in this space, industry experts from Lunar, Molo, TSB, Q2, HSBC, and more. So lots of experts to hear from. And to start off, we're going to be talking to Anders Hartlev from Lunar to explore the potential of buy now, pay later. And here he is behind me in the screen. So I shall take a seat and find out a little bit more. Anders, tell us what you do at Lunar and just where you're speaking to us today and just how excited you are about the possibilities of buy now, pay later.
Yeah, happy to. So my name is Anders Hartlev. I joined Lunar back in August last year in a role as Chief Risk Officer and Chief Financial Officer. And recently I was appointed as Chief Banking Officer in Lunar. I come from a background in Danske Bank, where I worked as Chief Risk Officer within credit risk management and also corporate finance.
Tell us a little bit more about the buy now, pay later tool, Lunar's tool, and just how it developed.
Yeah, so the pay later offering we have in Lunar is somewhat different than the typical buy now, pay later solution out there. So first of all, the solution is only available to Lunar customers. So in the online checkout flow, as part of the two-factor authentication, they will be routed into the banking app, and that is where the customer will be able to either postpone or split up payments. So the good thing is that we are not to go out to have agreements with all the merchants, but on the other hand, we are limited to the number of active Lunar customers in our account. But we can see that the offering is performing quite well, and it is a product that our customers are demanding. So in that perspective, it's been quite a ride to have it on our shelves.
And what do you think really differentiates Lunar's BNPL tool from other players on the market?
Yeah, first of all, as I briefly mentioned, it is the fact that we are only coming from the customer side. So the fact that we do not have a merchant agreement, that we do not get kickback from the merchants is a key differentiator. So that will create a somewhat more cumbersome experience in regards to that you are to basically you can't use it everywhere as a non-Lunar customer, but as we are a regulated bank, and I know that is most likely something you will ask into later on. On the other hand, we have the full requirements in regards to affordability checks, credit assessments, and the likes, and that is obviously easier if you already know the customer, because then you can offer the experience they want to see.
And looking at the wider landscape, what changes have you really witnessed, have we witnessed since BNPL really launched onto the market?
I think, first of all, the increased online sales has obviously increased quite a lot, especially during COVID. And then the technology has enabled that you're actually able to provide convenient and relatively cheap microfinancing that you wouldn't see 20 years ago. So the customer pain point in regards to financing is by no means new, but technology has enabled the industry to go a lot lower on the amounts and thereby also be able to outperform other point of sale financing solutions. So I think that's the key. You've seen that you've gone from the classical brick and mortar banks or financing opportunities and then closer to where the customers actually experience their pain, and that is for now in online payments.
And do you think that ultimately BNPL is actually going to replace credit cards for the younger generation in particular?
I think that is a good question, as both solutions have similarities. I think coming from the credit card side, you are able to mimic some of the BNPL features. So the payment plan, a competitive interest rate, and to some degree credit checks is one way for basically defending the credit card position. On the other hand, the regulators will come hard after BNPL providers, meaning that maybe the credit check part will come a bit harder for BNPL providers. So I think the winner of this battle will basically be the one that's able to meet the demand, and the demand is convenience and flexibility. So I think it's yet to be seen whether the credit card providers are able to deliver this or other options will arise.
Now, you talked about the accelerated shift to e-commerce that we've witnessed during the pandemic, of course, but what else do you think is really driving demand for BNPL?
I think it is, as you said, the online feature, but also the softer credit check that you see is obviously two elements. But I think when it comes down to what really matters, it is the convenience that you can actually apply online. You can get an instant answer, the flexibility in regards to what amount you would like to lend, and also your installments to this. So given you have a good month, then you're able to pay back more, and vice versa. And then I think obviously technology, access to data is a key enabler in this area as well.
Now let's touch on regulation, because you have briefly mentioned it, but the rapid evolution of digital lending, of course, has meant that many modern and increasingly popular BNPL products are currently unregulated. What is the situation in the Nordic region in particular?
I think so. Basically, I'm not an expert on regulation outside of the Nordics, but you see from also EBA guidelines that they are cooking on regulating the space to a larger degree. In the Nordics, the customer protection element is quite broad. So not only licensed entities are to basically live up to the customer protection rules. So when it comes to interest rate, when it comes to the fees you are able to put on delinquent customers, then obviously there are rules in this area. I think where we have the main gaps is if you have non-interest products, then you basically out of scope for regulation. And also if you are a creative provider, you're able to engineer solutions so you actually circumvent the rules. And I think that's mainly the focus now from the political side in the Nordics, but obviously also outside the Nordics.
Yeah, so in terms of this regulatory intervention, I mean, we're talking about things like affordability checks to arrears management. How do you think BNPL is going to evolve as a consequence?
I think, first of all, seen from my perspective, the regulation is more than welcome, as it is on the positive side. It will protect the weaker customers. It will secure a more level playing field amongst market participants. Then on the negative side, the convenience might suffer in regards to this, and the typical younger customers might not be able to have access to this funding source. But I think it's an acceptable price to pay. But most likely the market will on an overall level decrease. But I still think the demand for convenience, for flexibility will in the longer run anyhow win. So the winner will be whether you can embed it in other solutions, I guess.
So is that why you feel that it's commercially viable in the longer run?
Yeah, I think just looking at the investments in this space and also the corporate transactions you've seen, at least there a large part of the investor base sees this as viable. And I also think that due to the demands, someone will need to meet that demand. So whether it's BNPL, a 2.0 version of BNPL or more embedded in other solutions, I don't know, but I think definitely there's profits to be made in the value chain in online sales.
I mean, it is really clear that BNPL has really jumped into a gap in the market and has proved really popular among younger customers in particular. But how do you see its appeal widening to the older generations, for example, or even SMEs?
I think, of course, it's something you need to get used to. It's something that you need to have a demand for this. So if you have plenty of cash, it's not necessarily a thing you would ask for. But as you've seen in other technologies, other trends, then obviously some of the elderly will follow this trend. I think within the small businesses, there are a lot of solutions out there already in regards to invoice financing, in regards to revenue-based lending that also gives you a better working capital position. But BNPL for smaller corporates could also be one way to improve your liquidity situation.
Well, you said that you welcomed regulation, particularly to protect vulnerable customers, but what else should companies be doing to ensure that they are protected, that their customers, those most vulnerable, aren't left out?
I think first of all, the industry should obviously have the same agenda as the regulators coming from the consumer protection side. So in that part, I think the same goal should definitely be in place. And then I think financial literacy in regards to educating the customers is a must. And then I think also the basically enabling customers to leverage their consumption over time is something that is a need, and we should be able to cover that and still staying within regulation.
And what about other gaps in the market that you can spot right now? What kind of potential do you feel there is for other innovations in this space?
I think first of all, what we've seen so far are a lot of monoline providers delivering solutions in different spaces, and whether that is payments, whether it is lending or something else. And at least what from our side we expect is that some of this unbundling area will turn into a bundling area where the ones that are able to bring together these seamless experiences within payments, within savings, within financing, I think will be the winners of tomorrow. So I think especially the payment space is quite interesting. If you can leverage what you have of platforms from banking or other industries is interesting, and I think that's also a testament to where you see large acquisitions currently, is that people are bringing together solutions from what would be different industries and basically bundling it towards the customers. So excited to see where that ends.
Okay, Anders, thank you so much for joining us. It's been Really, really fascinating talking to you. So I do appreciate your time coming to us remotely, so thank you. Coming up, we're going to have the second interview of this session. I'll be speaking to Francesca Carlesi, who is the CEO of Molo, who is going to be talking to us about digital mortgages and the innovation in this space. So stay with us. Hello and welcome back to the MoneyLIVE Autumn Festival, and we're about to kickstart an interview with the CEO of Molo. Now, with a strong housing market and eager buyers seeking mortgages all over the place, there's never been a more important time really for banks to digitally transform their mortgage processes and businesses, and that's why we have Francesca Carlesi, who's the Chief Executive Officer of Molo, here with us to discuss all of this. So Francesca, this is a big topic, lots to get through. So I just want to find out a little bit more about yourself and the company and really what you're aiming to do. Just tell me a little bit more.
Yeah, no, absolutely. And thank you for having me. It's a pleasure to be here. So about myself, I founded Molo 3 years ago. So we're still relatively a young company. Before that, I had spent my career mostly in banking and consulting, so very traditional, and then decided to convert to entrepreneurship in a way, and I'm very, very happy to have done so. At Molo, what we've done, we effectively have taken a bit on the challenge to digitize and disrupt the mortgage industry, which is probably one of the parts of banking that's been lagging most behind so far. Clearly because there are a lot of regulatory burdens and it's a complex product, but what we aim to do is effectively to digitize mortgages so eventually people can just click a button, get a mortgage, and not go through the whole pain and long times that we have all to go through today.
So what are the benefits for mortgage providers?
I actually think the mortgage provider is the one that benefit almost the most because when you think about what it takes to issue or originate a mortgage, right now it's a very lengthy process also for a mortgage lender. So there are a lot of physical labor involved and a lot of human labor involved. So cost to serve is very high. So the main benefit, I think, of digitizing the whole process is that effectively you're taking away, you're stripping out a lot of costs from the process. It's at the end you're able to give a mortgage at almost half the cost if you do that. On one side. I think on the other side is also certainty and lower operational risk because if you automatize, effectively what you do, what we have done, we have automatized the credit decisioning and any task that we can automatize internally. So when you do that, you're taking out a lot of operational risk from the process as well, because effectively everything is auditable, everything is coded, and it's much easier also. You can manage huge volumes without having to be worried about risk and potential human errors that can happen.
And from the customer side of things, obviously many of us may have experienced difficulties perhaps and the admin of trying to get a mortgage, particularly if you find a property that you want to jump on straight away because the housing market's red hot and then you've been delayed by the mortgage process. What can digital mortgages offer for customers then?
Well, I think the digital mortgages are for customers, so it's precisely to give people a much better customer experience. And we say much better customer experience, we should think about what we're used to do today in every other part of our life. We are used to go online, open a bank account, make a payment, buy something on Amazon, right? Except when you do it for mortgages. When I got my mortgage for the first time, I had to print things and send pay slips and bank statement, which we don't do anywhere else. So I think the customer is the one that benefits the most, and is benefits in terms of speed, ease, and convenience. So it's about faster processing and faster time to yes and time to cash, or time to no as well. So one element of speed is certainty. So you don't want to wait 6 weeks to know whether you can get a mortgage or not, right? So speed is the first benefit. Ease is about, taking out any hassle from the process. Mostly for me is being able to go through a process without any paper. So being completely paperless and being completely digitized. And then convenience, because convenience for me is about also, once you take out the cost, automatize a lot, at the end you're able to have many more savings from the process that you can give back to customers. So eventually the old market will be much more competitive and customers can get better rates as well.
So what does this whole process of obtaining a mortgage digitally, but tell me about it. How does it evolve for the customer? Because I understand that brokers and advisors can still be involved, and that will be crucial for many customers, because these are huge purchases they're making, and they will still want a bit of hand-holding along the way rather than just a digital interface.
No, absolutely. And I think there shouldn't be any confusion between digitizing the mortgage process and then which channels you use. They're two separate things. So on the second topic, which is what you mentioned, so absolutely every customer, convenience is about the fact that everybody should still be able to approach, let's say, a mortgage through the best channel they want. So it could be a broker, it could be online, it could be a bank. It doesn't, a direct lender, right? So at the end, it doesn't really matter where you come from. What the digitization of the process is about what happens once you start an inquiry, right? And how fast and how digital and how easy it is to go through. And so what that means is it's about mostly three things in terms of, deep down, is about being able to go through a digital journey online, even if this is intermediated to brokers, but it's effectively not having to jump from one interface to the other, because it's all kind of interconnected. Second is about having real-time decisioning. So rather than having to go through a process, do a fact find, and then after 5 weeks having an underwriter that calls you and tells you, okay, I'm still missing the 5 documents, or maybe you're declined. Having digitized the process means that you are, as you go through it, you are told at every single step, yes, no, maybe. So it's real-time decisioning that you can know right away. And this is just because all the underwriting and credit decisioning is automated, effectively. And the third component, which I think is the most important one, is about where you source data. So today, we are asking, in a normal traditional process, we are asking customers to do a lot of heavy lifting to gather all the data, all the proof of income, all the proof of residencies. It's a lot of work. It's almost like doing a job for that. Whereas if you digitize the process, which is what we've done, we are using APIs to source data straight from the source. So we don't really need the customer, it shouldn't be the customer having to do all this heavy lifting. We source the data, we validate instantaneously. So it's about effectively instant data validation, so that from a customer standpoint, your journey is super slick, but behind the scenes, we're not cutting any corners.
So what does this look like, this streamlining look like in practical terms? I mean, what kind of technology, for example, is being used to do this?
Well, I think it's it's all the more modern technology. So what you need, we built our platform in-house, so it's a proprietary platform, so it doesn't exist. It's not that you take off-the-shelf solution anywhere. I think what you really need is a cloud-based architecture first. Now, this is the norm now in any more modern industry. However, in many banks, it's not still the case. You do need a lot of effectively microservices architecture in terms of your underwriting system and your credit decisioning and modular architecture there as well. And then you need to be able to leverage APIs as much as possible. We say at Molo, we love APIs. APIs is effectively an interface with other sources of data or information, because once you do that, you effectively can continuously enrich your data sources without having to change architecture. So these are all quite relevant. In terms of the other probably the fourth piece that is really needed, made a difference, is why this is possible today, it was not possible 5 years ago, is access to digital data. And that is a game changer. Digital data, I mean that if you want to source data straight from the source, you need to have a way to source them digitally. So the ability to have, data from credit bureaus, KYC utilities, AML, digital DMV, all digitized is super important. And within that, open banking has been a key ingredient, like a key enabler for everything, right? Which clearly is a new thing, but having access to transactional data, very granular from a customer, real-time digitally, is a massive breakthrough, because once you do that, you can instantly elaborate this data rather than having an underwriter having to go through a bank statement, a paper bank statement.
So in what ways Molo using real-time insights then? Is that part of this process that you're able to gather real-time insights?
Yeah, absolutely. So I think the difference is like we gather real-time insights in every single step of the journey. So the way Molo works is like a web app, right? So people go online, they inquire for a mortgage, they give us some information, very little. We source probably 10x more from the back end. And at every single screen, effectively, we have a decision happening, which probably from a customer standpoint, that don't even realize. And decision is either accept, decline, or refer. And so at every single screen, we are sourcing maybe thousands of data in the moment, processing real time through a decision engine, and give an answer to the customer. And so, effectively, these data points are used instantaneously to give an answer, which actually is very important, because it's even more important if, for example, we can lend to you, because then you just know upfront. You know after 30 seconds of an application, rather than knowing at the end after wait.
And, right? And could it be that then the applicant can then go back, source more data themselves, and then reapply and perhaps have a different outcome, but a lot sooner than they would have done ordinarily?
Yeah, absolutely. That's it. That's the other benefit of this, that because once somebody applies, we do source data and maybe we do some checks and so on, then the same person can come back, doesn't need to start from scratch. We already have an account, we already have something, we ask only what's differential to that. And this is super relevant for remortgages, for example. So one thing we should all know is that the UK market in mortgages is driven, 60% is a remo market, okay? Because people need to refinance every 3 to 5 years. When you do a remortgage, which happened to me when I did my first mortgage here, is that after 6 months, for some reason, I had to remortgage. And I was asked again, exactly all the same information, including my passport, from the same lender. And I was like, why do you need it? Because actually you have it already. And that shouldn't be the case, right? What you should do when you remortgage is just go online and say, I need to remortgage, click here, update the consents. We update your data and you're done.
Yeah, I mean, so many people say in the UK that moving house is like one of the great big lifetime challenges because of the amount of admin that you have to go through, and not knowing whether or not your house sale will fall through at the last minute because perhaps you can't get the mortgage approved. So what kind of speed can you add to this process? How much more quickly, for example, could a customer gain a mortgage compared to more traditional means?
So significantly quicker. However, we should differentiate. There are two key moments, I think, for a mortgage. One is what I call time to yes, and the other one is time to cash, which means when you actually complete, okay? So time to yes is how long does it take for you to have a binding offer that allows you to exchange on your house, which is key and crucial, because otherwise you can always lose out on your house, right? So time to yes is what we focus on, and Molo. So it's about how can we get people an offer, binding offer, as quickly as possible. From there to time to cash, unfortunately there is a legal process which is managed by solicitors in the industry, and it takes a little bit longer. We at Molo have not yet focused on cracking that or accelerating that, although we are working with digital conveyancers, so that helps us to accelerate that. So on what we have focused on, effectively, we can today give an offer even in 15 minutes, a binding offer in 15 minutes, and it's completely without cutting any corners, because if somebody goes straight through our journey, he or she doesn't need to even speak to anybody. We don't need to do any manual checks. You can go straight through. We can make our journey, you can do it in less than 15 minutes. It's quite good. Although not everybody does, because what we find out is that the capability is there, but some people then are still looking for the property, so they stop in between, then they come back, and then they can close it off.
So in what way is open finance really shaking up the mortgage industry when it comes to this pre-approval process in particular?
Yeah, well, open finance, I think, is a game changer for the whole banking industry globally. So I think there isn't any paradigm shift that will be in the long term more meaningful in terms of the way the industry will reshape itself, because effectively open finance, open banking first, and then open finance is now creating a level playing field in terms of access to financial data. So they are not anymore a privilege of banks, so it's not that anymore your bank, where you have a current account, knows everything about you, nobody else does. All of a sudden, if you give the consent, any lender, any financial service provider can have access to the same data. So this is a key enabler for the unbundling of financial services, which we heard about before, which is happening, is already happening. Now, for the mortgage industry in particular, it's even more relevant because in mortgages, this is a single transaction compared to any other lending type, where you really need to give every single information about yourself, right? So already now, you need to give full information about your bank transaction, statements, pay slip, and everything. So it's a huge heavy lifting to have to do it through paperwork. So open banking has allowed now all of a sudden to access that digitally, effectively unlocking something that was a key bottleneck for the process. So I think that access to bank account transactions in a granular way and being able to do it real time was a single piece of the puzzle that was missing for the digitization of the process. Because this is not about credit appetite, it's about affordability, and there's no other source, right, from that.
And so what impact as well, though, are we going to say product comparison as well?
I think actually the product comparison world will be quite interesting. It will evolve a lot. It's already starting to evolve. So let me explain in which way. So I think what we have today, when you go on price comparison website, is that you have a menu, laundry list, effectively, of products or mortgages. And as a customer, you are a little bit lost, to be completely fair, because you have 10,000 mortgages and you say, well, HSBC looks very cheap, it's a 0.9%. 9 cases out of 10, if you try to apply to that, you not qualify. So it's effectively a bit of fake laundry list because you really don't know what really is the real list for you, right? And inevitably it is like that. So you have a laundry list, you kind of get a sense of the market, and you need to talk to somebody, go to your bank to get somebody to tell you, listen, out of these 10,000 products, only 5 are okay for you, and maybe the price is much higher. So digitizing the process, so effectively being able to get customer information, check them in real time, and assess the customer in real time, so do a software check real time in 30 seconds, allows everybody to effectively, potentially with a very small journey of 2 screens, to get to a pre-approval, to a DIP, a decision in principle, real time, which could happen on the price comparison websites, which at that point creates a more level playing field in terms of you really a narrow choice of what are the products for you, and then you can get the right product for you. You always get the best price. Whereas I think today, people are fooled a little bit by the cheaper price, which probably is not accessible for them. So I think where the world will end up on the product comparison is that instead of having this laundry list and then having to talk to somebody, even in mortgages, there will be something similar to what is the insurance model before, right now, right? In the insurance model, you go on price comparison site, you put a couple of information about yourself, and you're given a lot of quotes, real time, and then you pick the best one for you, and you know you're eligible for that. I think that's where mortgages will end up. You go online on Money Supermarket, some other price comparison website, you click, you ask, you'll be providing a couple of information, and you see many, many quotes, but this will be already tailored to you.
Really interesting developments. And let's talk about mobile-friendly processes, which are a real must for so many different businesses. In your experience, what are the keys to success here?
Well, I think mobile is key. What we found at Molo originally, we built mobile first because that's where the world is going. But we built a web app assuming that people, for such an important transaction, they want to do it on desktop. And effectively, we found out that's not true. Mm-hmm. So the majority of our traffic, probably 60-70%, happens on mobile, which kind of is a big deal. And so that's why we decided that we'll build a native app as well. But I think so mobile everything is moving to mobile right now. So everybody needs to think about this. So the key success factor for me are mostly two. One is mobile is a lot about UX, a lot. So it's all about customer experience, how to make it easy. You have a small device, so the logic in which you ask questions, you interface with the customer is very, very different. So in switching to that mindset, it's not like taking a website and moving on a mobile. It's a very different UX, customer journey, customer experience. You need to know that. And it's not easy to do a fantastic mobile experience. The second thing is critical success factor is exactly not to replicate, not to think about mobile, about something where you replicate your web experience and translate it there, because the logic chain, be able to acknowledge how a mobile experience is different, not only from a journey perspective, but from a sequence perspective. So in a mobile experience, you can sign up first, give your information, then you ask questions. So you can just sign up with open banking first, rather than be asked a lot of questions and then give a consent. It's a completely different logic. A mobile app, you give information up front, and then you do other checks. So it's about recognizing that mobile is different and not trying to transpose there something that the same experience that you have on a website.
What's your view and opinion really on whether the incumbent players are they pivoting enough, do you think, to compete in this space, in your opinion?
Well, I'm going to be biased here, okay? And I don't know, probably there are a lot of people here that will be challenging me. So maybe what can I say is the following. I did spend my career before in banking. And so I kind of know quite well, inside out, what are the challenges that big bank faces. So I probably spend more time in banking still to now than in the more startup world. So, I can at least talk based on my experience. So my view is the following. I think not only mortgage, but in general, through disruption, it's difficult that true disruption comes from within. It's very difficult because there are two problems. One is legacy issues on the tech stack, on the processes, compliance, and procedures. And second is the incentives are not there. So if you are managing a big bank, it's like moving an oil tank, and it's very difficult to introduce a major disruption that probably cannibalizes half of your business. It's just not something you're willing to do until there is a threat, until you have to do it. So I think that inevitably, I think it's easier for challengers to come into a new space, be provocative, be disruptive, and also because you're starting from a clean slate in terms of tech stack, in terms of procedures and everything, and you can design for the future rather than having to fix something to evolve it. So in particular in mortgages, the same applies, squared. So I think in mortgages, I think it's fair to say not much innovation has happened. It's innovation that was customer facing. Now there is a moment in time when this is possible. I do acknowledge that the industry as a whole, big banks are looking into this, but I think it's the speed of change, the speed of development, inevitably is slower, right? So, but I think things will move eventually, and I think if people like us, come in the market not only just because we think it's a massive opportunity, we love giving better customer experience, but I think by being the agitator in the room, we can probably create a better customer outcome. So if competition brings benefits, right? So I think, the industry is not probably moving as fast as they should, but it's inevitable. But I think that challengers coming to the market can be beneficial in that, right?
And so what other innovations are you particularly excited about, which could help more closely link customers and brokers and lenders and create a smoother customer experience? I mean, I'll be interested to find out your views about how the whole legal process as well, in terms of buying a house, could be speeded up. Yeah.
I think, unfortunately, legal process is still the pain point and the bottleneck, so we and Molo will start looking into that next year. But unfortunately, still the bottleneck because I don't think there's been real innovation in that space. Now, in terms of going forward, what innovation will make it all smoother? So I think, for me, there is one overarching principle that will happen, okay? We should not forget one thing. From a person, a customer, so wants to buy a house, not a mortgage. don't care about the mortgage. In fact, if you could just click a button, get it sorted, you rather do that and just focus on the house, furnishing the house, and all that. So if you think about what that experience is, from a customer point of view, what really matters, then the only way to achieve that is by ensuring a much better integration of the full value chain, not just the lending value chain, but the home buying. So shifting home financing from home financing to home buying experience. So I think what will enable that is is an embedded mortgage experience. We're talking about embedded finance a lot, and I think we'll get to a point where effectively we'll have embedded mortgages. We are already thinking about this, where effectively you go right move, you see a property, you have a button there that says, okay, you like this, click here and you can finance in 10 minutes. That is the ultimate goal, because at the end, you then focus on the property, you forget the mortgage, and you click a button, it's all in the back end, it's all integrated. Now, from a technology stack point of view, how you can achieve that, to be honest, you can achieve that today. You don't need too sophisticated things, provided you have APIs. APIs are magic. You can integrate in the back end, and from a customer standpoint, everything is very sleek. Now, clearly the next level will be blockchain, because from a blockchain will allow you to, it's almost like, because you have a token where every single thing you do is kind of carved in the token, you don't need to do double checks, which is what happens right now, right? So I think eventually the whole mortgage industry will be tokenized, will move to blockchain, and then we make it much easier. I just think we need to do baby steps to get there, right?
And you mentioned embedded mortgages. Just how far away do you think we are from that becoming a reality?
No, I think it's very close. So it's already technically a reality, because you don't need much. I think you need a public API. We have already built, for example, a public API where you can get an instant dip. We could just position a right move on Zoopla everywhere, and that's what embedded mortgages is. It's like almost like embedded finance. You go and on Amazon, you want to pay something, and you pay through Klarna. What that is a public API. So in fact, you connect, you go through a separate journey, and the two things are interfacing, and it's an exchange of data. That is already happening. In fact, it's already live. Now, it's not real, and it's not live in many platforms, because nobody's really thought about this. So I think we have a little bit the ambition to be the first ones to pioneer that. And
do you think working with third parties will help propel you on that journey? You're excited about the possibilities.
Yeah, absolutely. So in fact, I think this is we should all think that this is an ecosystem, and if you are working with other parties, part of the home buying ecosystem, I mean, there'll be much better customer outcomes, but then also much less frictions, right? Because one of the reasons, of many reasons, but one of the key reasons why mortgages are not really innovative is because it's so siloed. So effectively, if you have many silos, you have the brokers, you have the lenders, you have the conveyancer, the surveyors, and so on. This is a roadblock to innovation, because everyone can innovate in their silo, but it doesn't matter, because you're stuck. You're only as fast or as slow as the lowest part of the value chain. So the moment you go through an embedded finance journey and you partner up, you're cutting across everything, and then you can give a much, you're not slowed down by anybody at that point.
Very exciting. Francesca, it's been really fascinating to hear you talking about all these innovations taking place in the space, helping the home buying process be that little bit easier, and that's, I'm sure, what we'd all like to hear. So thank you very much for your time. Really appreciate it.
Thank you. Thanks a lot. Thanks for having me. Brilliant. Thank you.
Hello and welcome back to the MoneyLIVE Autumn Festival, and we're about to start the fireside chat of this session. We're going to be discussing the role of cutting-edge technology and new data strategies and what they could both play in not only speeding up credit decision-making, but also increasing accuracy and also protecting the customer. So I'm really delighted to have two experts in this field join us here on the stage. Borkakoty from TSB. Hello there, Charisma. First of all, tell us a little bit about your role and what you do.
Sure. Thank you for having me over, first of all. I'm Charisma, and currently I'm heading up the commercial credit risk portfolio for TSB Bank.
Lovely. And Travis Wilson. Travis, tell us about yourself and your role.
Yeah, thank you very much for having me. I think, first of all, it's great to be back in person. After so long being, virtual, it's great to be back in person and doing something real. So my name is Travis Wilson. I head up Q2's banking and lending business in EMEA. For those who don't know, Q2 is a global leader in financial technology and software solutions. Within the region, we focus predominantly on providing an end-to-end lending solution to banks and alternative lenders of all shapes and sizes.
Great. So really great to have you both with us on the session today, because of course the pandemic really did have a huge impact on credit decisioning. It saw changes in customers' needs and behaviours, of course, and really did upend how lenders assess credit risk and also build their decision strategies. But after more than a year of all of this upheaval, transactions and credit risk decisioning, I think, is starting to return to a bit more of a familiar pattern. So, Charisma, tell me, do you think, even though we're almost returning to more familiar ground, that the experience that the industry has gone through over the past 18 months, do you think they've ushered in a bit of a new era, really?
Absolutely. I think it's pretty much the recalibration of the credit world, right? And last 1 year has been a significantly challenging year, and the lending world, particularly the traditional lending world, I think they pretty much understood the need to embed a very, very strong data infrastructure. I think that's pretty much the, it's you can call it a new era, but it's not a new concept. And it is understood that pretty much it underpins the ability to understand all the risk that we have faced in the past 1 year, and we're still facing. We're still learning on an everyday basis. And the other bit is the ease of data availability. The data is there, but if you don't have the data, how do you churn the information? How do you get it insight? But the big bit, the new path, I would say, I think the banks and the lending world was mandated or forced to adopt the digital transformation, right? It supercharges pretty much the data infrastructure, the data availability. And when you have this rich insights available, that pretty much push you towards, having your upstream, downstream agendas sorted, sort your credit risk models, sort your, credit insights. And that would pretty much influence all the credit decisions, right? And then that kind of links up the whole sort of profitability side of things, returning more capital on capital for shareholders and so on and so forth. But I think the story here is embedding a strong data infrastructure fueled by digital transformation. I think that's what we have observed in the past 1 year.
So, Travis, would you agree? Is that your perspective as well?
Yeah, absolutely. I think, undoubtedly the pandemic had a massive impact on the lending market in general, and credit decisioning is obviously one important part of that. Funnily enough, when the pandemic first struck, we started speaking to a lot of our clients to make sure that we were there to support them through the turbulence. And an interesting piece that came out of a number of those sessions was the need to obviously look deeper and wider into the data within the banks and within the lenders. And that was a particular challenge for some of the underwriting teams and the credit teams. And what we were working with our clients at that stage was, how do they leverage the technology that they have within the bank, or that we were helping them implement to, facilitate that process of looking deeper and wider into data, for example. And a number of lenders that we're working with and banks that we're working with are using those experiences that they've garnered during the pandemic to essentially foster a way forward, learn from those experiences, and use it as a bit of a springboard to continue on their digital transformation programs.
Yeah, and also, Charisma, the other element that I think has really accelerated is that customers are expecting banks more and more to provide services much more quickly and easily. And what experience has the past year shown us in terms of how banks can offer fast access to finance for customers who might be facing real times of difficulty?
That's an easy question, because my answer is same as the last one. It's a digital transformation, right? Look, the idea is to tap lots and lots of data in a quote unquote automated fashion, right? If you have the data available fast, really rich and insightful, that pretty much reduces your compilation time. And that kind of leads to, start to think about synthesizing or creating this new set of pre-arrears triggers. And that pretty much tells you the story of customers or businesses getting into financial difficulty rather than being in financial difficulty, right? So it's proactive. And that pretty much influences the, I would say, enhancement of the proactive customer touch points and the ability to pre-assess the customer's worthiness, right? Who do you want to support?
Even in times where there's not so much urgency.
Absolutely. I mean, you don't need to wait for that, right? You're able to understand the customer way upfront rather than being more reactive. And there's other aspect to it. In terms of mobilizing the operations, for example, you don't need to restrict them just to process transactions. When you have this automated pre-arrears data, you have the information inside available to tell you what your customer wants, what they're facing, right? You're able to go ahead and advise the customer with the right options and products. You don't need for them to come and tell you, you know what, I'm in trouble, right? That's the power of that digital transformation, the automated technology telling you the insights. The other thing I want to say is about COVID, which we can call as a one-off event, right? But if you had this data, or if we had this data available to tell you the story, you know what, there's a risk event, there's a risk trigger, the banks can start to behave like tech companies. You have the data telling you the story. You're able to react right there and provide the right option and support. You don't need to wait for the pandemic to happen. And I think, COVID may not have been a one-off event, but I'm quite sure that in a few years' time, with this data, digital transformation, I think we can tackle one-off events quite well.
But the accuracy of this data is absolutely crucial, isn't it, for credit decisioning? So how can you use, do you think, Travis, new technologies to increase accuracy? Because this is key, isn't it?
Yeah, absolutely key. A line that I tend to often use is empowering humans through technology. And just to expand upon the human elements, how do we put technology in front of our RMs or our credit teams to make them more effective and efficient at their jobs, right? And what I mean by that is a main pain point in a lot of this process is the friction between frontline and credit. So when that customer is first engaging with the bank, the RM originating the loan or underwriting the loan, getting that through to the credit team, that friction has caused a lot of problems in the past. And once again, the digital transformation programs that we're a part of is fixing a lot of those problems. So once again, just leveraging technology, making humans more effective and efficient in their roles.
And if there was one specific technology that's truly transformative, which one would you really invest in, would you say?
Yeah, I mean, obviously I'm going to be quite biased here, but funnily enough, one of the biggest problems that we see at the moment is, okay, so we talk about end-to-end lending a lot of the time. Portal technology, bringing the customer closer to the bank, RMs better effectively originating the loans, the management of that loan throughout its life cycle, and ultimately collections of delinquencies at the back end. But a main issue that we see in the banks at the moment is pricing of commercial loans. Typically, that's done on outdated technology being Microsoft Excel spreadsheets. Now, let's just think about that for a second. Billions of pounds of loans every year priced on a spreadsheet. I mean, that's just crazy, right? Imagine how much operational risk is involved in that process. And we're speaking to banks about leveraging technology to overtake that kind of outdated silo technology of Excel spreadsheets, using software, API-led technology to price those loans to reduce the operational risk. So yeah, fixing that pain point around pricing commercial loans for us is absolutely key.
That's really interesting. And Carissa, I just wanted to ask you, we did touch on data, obviously, but what other kind of more unconventional sources of data could be used, do you think, thinking outside the box to try and optimize credit decisioning?
Absolutely. First of all, what is conventional data, right? Simplistically, that's your credit history, fitting your risk appetite, influencing your credit decision. Now, the question is, what happens to those customers who don't fit into your risk appetite? How do you support those customers and businesses? And especially in the past 1 year, you have this new generation of customers or businesses that have evolved, and they're absolutely invisible to the credit world. So there is an understanding that we need to go and support these customers and businesses. Hence, there's a consideration that let's look beyond this typical traditional credit history type of data, and let's look at data which can help boost these customers getting their credit file a bit more thicker, right? And I would like to take the example of a utility bill because I think we're all familiar with that. And it's a very strong third-party verified data, very little fraud, gives you a very rich information about customers' timely payment history. And I think that really supercharges, right? I mean, what else do you really need? Then you have, we heard about buy now, pay later and social media. I mean, these are not part of any mainstream credit scores or bureau scores as of yet. And that can really boost or, help you get, marginal loans approved. Just reading an article lately, bringing up unbanked customers and businesses across the world can generate up to close to $400 billion in new revenues globally. That's a huge chunk. That's the potential sitting there. And really, I believe this unconventional data would not be conventional after a few years when you and I be talking,
But what are the barriers, though? Why isn't it happening?
Good question. I mean, that's the value of the unconventional data. The barriers with all good things, they all are there. I think the biggest barrier is how do you interpret this data, right? Because think about it. I mean, the biggest dependency is the customer agreement. Customer has to agree to opt in for that data to be shared. So as a lender, traditional debt, when I look in this data, it comes absolutely unstructured and incomplete. How do I create a behavioral pattern? What does it mean to me? It's so incomplete, right? And it doesn't help me to build that story to say that, okay, this is the credit file and I can go and start, lending to these customers. Then the technology. Data is everywhere. How do you go and mine this data, develop it, test it? And it's ever evolving. How do you manage? How do you monitor? It's agile, right? The regulation of this data. I think there are a lot of challenges. And you know what? It's not alarming that you know the challenges. It's good that you know the challenges so that you can work upon, and this should be sorted in a few years' time.
How, though? I mean, do you work with third parties? Do you work with independent research? How can you get a handle on it?
I think that's there are many ways to do this, right? I mean, let's think of this as a commodity. You just can't start. You can, but I think that's significant amount of time and investment. I think, as you said, you have to partner with a lot of third parties to get this sorted. But I think it's still at a nascent stage. And I come from a traditional bank, so it's pretty much at a nascent stage, but it'll be there.
Okay, so Travis, let's move on because we can't talk about lending and credit without discussing risk. So how do you think technology can best support credit officers and relationship managers?
So I think a big area for me is operational risk. It's often very overlooked, and I think operational risk can easily be solved by implementing the right technology. Speaking about data, it's all very well and good getting as much data into the bank as possible, but how do you actually make your team leverage that data in the decisions that they're making on a day-to-day basis, whether that's originating loans, pricing of those loans, or underwriting those loans? So yeah, the operational risk area is something that we're speaking about a lot with our clients. And when I say operational risk, I mean things like human error, double keying, siloed, outdated technology within the bank, how do we get rid of that and implement technology that's collaborative, that your RMs and your underwriting team or your credit team can be using collaboratively? How are you getting customers' information into that platform to basically streamline the lending operations more effectively, more efficiently, at the same time reducing that operational risk by double keying on multiple systems, or the human error involved that is obviously prevalent in a lot of this kind of credit decisioning underwriting processes at the moment.
And Charisma, how do you see this relationship evolving between relationship managers and customers, and what kind of technology do you think could be used to try and enhance this relationship?
Yeah, I actually see a risk here. I want to call it risk to the relationship, right? I mean, technology is great. I mean, it can definitely enhance. I mean, it applies to all throughout the life cycle of the customer, and that relationship is pretty much overarching, right? But we need to remember, we need to be mindful here that technology is to enhance, but it cannot really replace that human interaction. And I want to give a classic example here. I think we all have experience at times, when you try to get into customer service or a cancel flight or, your bank, and you're desperately, wanting to speak to a human, and every other option on your dial pad, you end up speaking to a bot. And it's like, I'm so frustrated, I don't want to bank with this bank anymore. I don't want to fly this airline. You don't want that situation, because this is where the technology is actually creating that barrier. And there are journeys which are absolutely self-serve, end to end, so no doubts about it. But I think technology should be modeled in such a fashion that there should be a proper fallback, to that human emotional touch when there needs to be. So I think that should be a blended approach.
How do you think this should be managed?
Yeah, I think just to follow on from that, really, I'll go back to my line around enabling humans with technology. And I think if the pandemic taught us one thing, was the fact that we still want that human engagement, but we want it on our terms. And when we do have it, we want it to be effective and we want it to be efficient. So I think that's a key focus for a lot of the lenders and banks going forward.
And, looking to the future, really, what do you think the next big change is going to be for digital lending? What do you think, Charisma, we should be really keeping an eye on right now?
I think AI, probably. That's what comes to my mind, and I think the key question here is the difference between, the current technology and AI. And again, I love giving these examples. So let's think about, again, as a traditional banker, I would create a model expecting, thousands and millions of my customers fitting into that model and raking Y% of profits, for example. But in AI terms, it's pretty much self-creating these thousands and millions of models, targeting these thousands and millions of customers, targeting customers as small as one. That's the power. That's the level of targeting and analytics driving margin, right? And it's just not credit. It spans across, front, middle, back office, throughout. And the integration, new technology, I just don't want to restrict to AI. You have these cloud-based platforms, open architecture. I think all of these capabilities together is what drives the speed, efficiency, and the reduction of cost. So I think all of that together, I would bundle up and call it, the new digital or the new change in the whole credit journey.
Yeah, and what do you think, Travis?
Yeah,
what have you got your eye on?
Charisma's, stolen my line there, but I think AI is absolutely key. But the reason I think so, and just to expand upon that a little bit, is we recently ran a poll through The Economist, and it was a similar question, what does technology mean for lending going forward? And by far, the biggest response was around AI. But I think, AI is such a big term, and sometimes it kind of seems a bit out there, far to reach. But in real terms, something that we're working on already with a lot of our customers, and this ties back to the pricing of commercial loans, is how do you use AI to read the data that's already in the bank to facilitate structuring better deals on the front line when those RMs are pricing those loans? And how do you use that data through AI, once again, to coach those RMs going forward to structure better deals that work better for their clients, but also work better for the bank according to the bank's current risk appetite. So I think, AI is already here. It's already in progress. We're implementing technology with a number of lenders around it. But I think it's definitely something that we need to focus on going forward.
But I suppose the issue is that, AI, can't be leveraged to help those unbanked customers, though that great potential out there, if you're not using the data that they can provide because those data sets aren't already inputted?
Yeah, absolutely. I think that's going to be a challenge going forward, and certainly something to keep your eye on. But I think, immediately something that we can do to make those better experiences for bankers on the front line, the borrower experience, facilitating better deals, is using data that's in place and leveraging AI to mine that data to coach the RMs into better deals going forward.
Okay, well, thank you. Yes, go ahead.
Yeah, actually, I want to add one more bit here. So we're talking a lot about credit. I think there's one big piece which we all have observed, especially in the small business sector in the past 1 year, is fraud, right? That has significantly grown up. It's like a fraud of its industry on its own, right? And I think with AI, I think that automated fraud monitoring, you have this compliance and regulation, spanning thousands of pages. I think the cost to the reputation, I think it outweighs way more than what it costs your balance sheet. I think that's the power of AI, in the fraud spectrum.
So huge potential. Well, thank you
Huge.
so much,
Huge.
Charisma and Travis. It's been really fascinating to have you here at MoneyLIVE. Really interesting perspectives and a good glimpse into the future as well. So thank you very much. Now, in our final lending session of the day, we're going to be putting a spotlight on the customer and also how the industry can enhance a financial well-being. We've got 4 fantastic speakers coming up who are in the wings waiting. So don't go anywhere. Join us in a moment. Hello and welcome back to the MoneyLIVE Autumn Festival, and we're just about to begin our last session of the day here in Studio 3, and we're going to be speaking about affordability, credit, debt management, enhancing financial well-being for customers. And I'm really pleased to say I'm joined by 4 industry experts to discuss all of these topics. So let me introduce them. First of all, we're joined remotely. Hello, Nigel, by Nigel Cates. Great to have you with us, Nigel. Tell us where you are and what you do.
Hi everyone, and sorry I can't be there in person. So I'm Nigel Cates. I'm head of the financial support teams at HSBC UK. So I look after the teams that support our customers who get into financial difficulty. We've got some quite big operational teams, and obviously all the support that goes around them. I'm in Worcestershire in terms of where I am in person. I'm at home because I wasn't able to get down to London today, but I'm there in spirit.
Well, it's great to have you here remotely, so thanks very much, Nigel. And also, let me introduce Lucy Hasson. Lucy, tell us about yourself, what you do as well.
Hi everyone, I'm Lucy. I'm like Emma, I'm a reformed lawyer, but I've had the privilege for the last 4 years of building and launching and developing a SME unsecured lender called Esme Loans. Working alongside Simon, actually. And the other point I should make to everyone is that I'm Northern Irish, and so if you need a translation, stick your hand up. Simon's worked along with me long enough to be able to do that.
That's brilliant. Thanks very much, Lucy. Okay, please introduce yourself. Emma, we hear you're a reformed lawyer. What else do you do?
I am indeed. So I'm the Chief Executive of the Lending Standards Board, or the LSB for short, and we are the primary self-regulatory body for the banking and lending industry. So our role is to drive fair customer outcomes, and we do that through oversight of various standards and codes that we're responsible for.
Well, thank you. And finally, Simon, please introduce yourself. Tell us what you do.
So I'm not a reformed lawyer. I'm CEO of a platform called Funding Options, and we are Europe's largest marketplace for SME finance. So quite clearly, as the name suggests, we help businesses get access to vital finance to help them thrive.
Okay, well, thank you very much. So real industry insights at the ready. So as we know, over the last 18 months, financial well-being really has come to the forefront as a major priority for financial services because the pandemic really turned things upside down for so many people. Now, lenders have been really looking for the right way to support their customers and enable them to take control of their own finances, which is a really truly important initiative for society. So Emma, just tell me, give me the overview, just how have lenders had to pivot their lending offering over the last 18 months?
Sure. Well, I think there's two ideas I'd like to throw in the mix initially, and then I think it would be great if we could come to Lucy, because I think she's got a real life example of a lender pivoting over the last 12 months. But from our perspective, the first would be, to steal a term from a previous session, digital transformation, but not just from the firm's perspective, from the customer's perspective. So online banking, digital banking was already in place before pandemic, but because of lockdown and restrictions, customers had to get to grips very quickly with not being able to transact face-to-face, potentially not being able to transact over the phone, and therefore moving on to digital platforms. So firms have really had to make sure they have in place the support mechanisms to enable customers to make that initial transition, and then that continual education of customers about how they make the best out of those online services. And I think secondly was around products innovation. So a prime example of that would be the government support measures put in place for businesses, and firms had to very quickly operationalise those measures in May last year. Product design initiatives that probably would have taken months before suddenly were implemented in weeks. So I think those are two key pivots that we've seen at the LSB.
So customers and staff and employees and businesses have had to get used to this huge shock and really had to pivot their businesses. So Lucy, I mean, Emma mentioned you've got a real life example. How has it affected companies in particular?
I think what we saw through the pandemic, so obviously we were operating a unsecured digital lending platform pre-pandemic, and so we were very familiar with open banking and driving customers through a digital journey. But we're struggling with uptake. As the pandemic hit, what we saw, which I am sure resonates across the whole industry, is that in those sort of days and weeks and months when the government was pulling together the government lending schemes and support for the country and trying to understand the size of the risk, we were having desperate, frantic phone calls from customers every day. And within, the first couple of days, it's sort of that last weekend in March, over a third of our customer base contacted us looking for repayment holidays. I think when you look, we're in the SME space, when you look at actually what people hold as cash reserves in the SME space, there's like 14 to like 20% that hold 3 months worth of cash reserves. So immediately as you moved into that lockdown period, people started to really panic. And obviously started to really worry about the cash flow they did have, how they were going to prioritise where that went, and started to reach out to all of their creditors to say, can you give us support? And we had this very slick sort of unsecured platform. We could give you a lending decision in minutes, but suddenly we had to transform that to create payment holidays. And so I think that was the first sort of product innovation that also the banks needed to digitalise, which is creating payment holidays for people and basically letting people pay interest, giving them either capital and interest repayment holidays, and then simultaneously building all the government lending schemes alongside that. So it was a transformational time. And I think also the other point for customers is that suddenly we saw people coming to market who hadn't been in the market before. So it has changed sort of the face of lending. We have customers who've come to market who would never have lent, would never have borrowed money before or considered it. And I think that changes the market fundamentally as we look forward and sort of post-pandemic, because actually your kind of customer base has changed. There are more people who now understand lending, are probably more receptive to it, and also they're much more receptive to some of the tools that can facilitate that and engage with it.
Yeah, so rapid change. Lucy's identified. Simon, how would you say it's really affected customers, not just retail customers, but also business customers as well?
Yes, everybody had to pivot. I mean, it was one hell of a roller coaster ride, to be quite frank. So, our demand from our business customers was absolutely huge. So this was sort of back in March and April 2020. We saw these huge spikes in demand. And again, it was businesses who were panicking, right? They had to obviously shut up shop, depending upon what sector you're in. And they were looking to borrow money to ride out X period of uncertainty. Nobody knew that was going to continue for a year and a half. So we as a business also had to pivot because the supply side effectively dried up. So there was very little market-based lending because the lenders had no understanding of the market dynamics because everything had changed. This was something that nobody had ever seen before. So how do you ascertain the risk of a business that is shut? Effectively, you just don't lend, ultimately. So the lenders pulled out of the market almost entirely for about a 2-month period. Then obviously the government schemes got announced. The lenders started to get to grips with that. Obviously the banks first for obvious reasons. And then we pivoted to help distribute CBILS. So I think we processed more than £1 billion worth of CBILS loans. And that was quite successful. Overall, I think we've all seen increasing digitization. I actually think that's a good thing. We've seen the rise of the e-commerce lenders over the last 1.5 to 2 years. So as a number of retail outlets went online and started to use things like Shopify and eBay and Amazon, et cetera, that enabled these e-commerce lenders to effectively thrive and really sort of take market share. So it's been incredible change. Where we are now, I guess, fast forward, it's not quite 2 years, but not a million miles away. We're hoping for some kind of market norm, because the dynamics of the market for SME finance have been changed by the government schemes. Some of it is okay. Other aspects, it's distorted it in a negative way.
Okay, so that's the perspective of Simon. Let me bring in Nigel. Nigel, does that resonate with what you're seeing as well?
Yeah, I think so. Look, and I agree with everything that's been said. The one thing I'd add as well, though, is that the pandemic brought maybe a greater range of issues. So quite obviously, you had the customers who are directly affected by the pandemic, maybe with quite short-term issues. So very stable in their finances, resilient finances, except for the pandemic coming along to impact them. It could have been the lockdowns, could have been direct impact of illness, but able to bounce back fairly quickly when that's ended. And then running alongside that, you've got longer term problems which probably align to the wider economic picture, affecting different people or different firms in different ways. And then you've got everything else that would have happened anyway, but for the pandemic. It's difficult for firms to differentiate that. The session before this talked a lot about data, but data obviously sort of talks about what's just happened or what the past story is, not necessarily about what's going to happen next. So the thing that I would add in is the sort of change around customer engagement, and that's been a real focus of ours. But customer engagement was driven quite high by the focus on payment deferrals. Initially, customers reaching out to lenders, as I think was already just mentioned, for support because they had questions, because they wanted to understand what support was available. And that's continued through the sort of 18 months since then, that we've had high levels of engagement with our customers, which gives us that ability to really sort of delve into their individual circumstances and work out what's going to happen to them or what they foresee on the future for themselves, and therefore make the right decisions for them.
Okay, and I want to ask Lucy now, thanks Nigel, you talked about the payment holidays, but are you seeing kind of a more of a longer term impact on repayment behaviour, do you think, or do you think it's still just short term and there's a bit of a resumption to more of a norm?
I think fundamentally it's changed everything. I think it's changed everything for all of us individually, and we are consumers. And so our change behaviour changes, fundamentally it all changes cash flows for small businesses, whether they were businesses that were impacted directly and having to shut down, or whether they were businesses that were impacted by supply chain disruption, staff shortages, it all came exacerbated by Brexit in between. I feel that cash flow has changed. It's no longer, before cash flow was an expected thing, and so we could all sort of run affordability statements and we'd look back 3 months and we'd automate all that data and we'd say, okay, this is your affordability and this is what we'll lend to you. I think a lot of that fell away, and so I think cash flow became more uncertain, sort of irrespective of where you are, and there's inflation, there's everything else that's happening alongside this. And also, I think, and then alongside that, with the government support schemes, what we saw is longer term debt. So I guess the average tenor on a loan has gone up. we saw sort of lower interest rates, again, through the government schemes and the business banking, loans which were less tied to credit, right? BBLs were just as flat interest rate for everyone. So I think customers' expectations have changed. I think they expect greater flexibility. Like Nigel said, I think capital repayment holidays will be there forever. I think the introduction of pay-as-you-grow is really interesting. And I think that we'll see lots more traction around that as we build that out. And I also think, it's been this great rehabilitation of the banking sector post the financial crisis. Suddenly the banks are there and they are giving you support, and they are very focused on that support. And whilst they all stepped away for 2 months, as Simon said, they then kind of rallied around the core banks to basically say, okay, how can we support you? How can we rehabilitate you to get through this period so that we can all perform together again? So I think it's sort of all change.
Yeah, and it's really interesting you talk about that kind of change in perception of the banks. Let me bring back in Nigel. How do you think going forward that there could be better processes and put in place over the longer term to better support customers? Do you think how could it be strengthened in a way?
So we heard in the previous session, as I referred to, around the use of data, and I think HSBC, huge institution, legacy systems in some areas, and we've accelerated our own use of internal data, but also linking up with open banking data. So really maximising the use of existing data, whether it's from internal, as I say, or from bureau, and then I guess application data, existing customer info in a number of different ways. So maximising the use of that. But then I think also looking to see where new data sources are available, to enhance an understanding of customers' latest position, so that you can sort of get more on the front foot, move into earlier intervention, spotting the warning signs, seeing maybe a drop in turnover, drop in income, changes to benefits being received, maybe an introduction of benefits being received in customer data and things like that. Things that just enable you to get that small sort of glimpse into the future. I talked just in the earlier question around engagement, but I think that's a really important part of the process. So customer affordability is not just around the data, it's around verifying, it's around probing into a customer's circumstances and really sort of trying to understand what that customer's position is and how they view it themselves, and also to look for any elements of vulnerability. If you're reliant on huge forms and very sort of long hour-long conversations on the phone to get that information, you're turning customers away. Basically, it's not going to work. You're not going to get the information. You're not going to get that conversation with the customer. So moving into digital technology, mobile technology, the way that customers behave themselves and the type of interactions they use themselves, I think it helps all of that.
And let me bring in Simon. Do you think this can be transferred to the mortgage market as well? Because we know that affordability for younger people in particular, trying to get into the housing market is an absolute nightmare. And do you think that affordability testing can actually adjust to adapt to their circumstances?
I think yes, in short. So we're huge advocates for the use of data and technology, but always very much in tandem with the human input. So that's something we're massively committed to. It's the three working in perfect unison. Ultimately, it's a bit corny, but it is what it is. So the use of data to assess affordability, regardless of the product, be it a mortgage, be it an MCA, be it unsecured lending, secured lending, etc., absolutely, that's critical. And I think open banking is one step forward. So we have used that as a key enabler for the power of our platform. So we're now powering approvals of loans in seconds and actually money in businesses' bank accounts in minutes, and that's genuine. That's happening through our platform today. So the more we can enhance the use of data, so open finance is obviously the conversation that's going on at the moment, the more we can pull in additional sources. Data tells a story. You don't just need a human to tell a story. Data tells a story. Totally understand the point that if there's a date in time where there wasn't any activity, you have no data, but provided you've got the longevity of a data trend, for us, it's incredibly beneficial.
And looking at the whole journey in supporting a customer, there is frustration among many customers that they might get a certain way along the path and then are rejected. What can banks do, Emma, would you say, to support and inform customers at the start of that journey when it comes to affordability tests, for example?
Well, I think for me, it's really setting the tone of the relationship you have with the customer right at that first engagement, and that covers all types of channels. So we're talking about human interaction, but clearly there's digital and telephony channels as well. Ultimately, what you're trying to achieve is ensure that customer fully understands what they're signing up to. They've got all of the facts, and it's easily understandable by them. And that goes to the basics of what the product is, what the eligibility criteria are, what it means for the customer in terms of their day-to-day repayment and the product life cycle. But that initial engagement, however it's achieved, is also a real opportunity to fact find for the firm and to work out from the customer's perspective and to get the customer thinking, is there anything in the future that might challenge my ability to service this product and to continue with my commitment? So I think it's firms looking in the round at that initial engagement as that really key piece of setting the tone in the relationship and keeping that process under review, which I think is really important as well.
Let's focus more on vulnerable customers, because actually the last 18 months has shown just how vulnerable people can become so quickly, almost overnight. Lucy, from your perspective, how do you think banks can identify much more quickly a change in circumstance which may affect their customers, and how can they support them by doing so?
I think, so obviously I come from a unsecured lending platform, so it's a product and not a bank. So I think it depends the organisation you're in and the data that you have. But I think the key thing, and we talk about data, and everyone's talked about it today, is obviously looking at the data you hold about the customer. Transaction data is always key, and then working out whether there are changes in that behaviour that are indicators of vulnerability. I think, as I was sort of preparing for this last night, I read a study from there's FCA and Experian who basically said, which is a sobering thought, that more than 50% of the population have indicators of vulnerability. And when you look at those underlying indicators of vulnerability, they are financial resilience, inclusion, sort of one-off health crisis. And I think when you actually look at those, you also start to think about, okay, what is the underlying root cause of that? And part of that is education. And I think that we have a bigger issue around financial literacy and actually how we educate people from a much earlier age. And so I think it's incumbent upon all of us to teach our children to talk about money in a way that we have not done before. Because when I look at the vulnerable customers that I see in sort of the business that I run, often what people do is sort of stick their head in the sand. And so a stressful life event happens, and this is added stress. Debt is still shameful, I think, for a lot of people. And I think instead of having a proactive conversation that takes away that stress, one of the fallbacks that we have in organisations and financial institutions is really to kind of step back and try and give people space. And actually that may be the right thing to do in certain circumstances, but really we need to be helping people through life to become much more financially literate so that they can have these conversations confidently. And I think we need to create that space. We obviously need to be able to identify the indicators and train our staff so they are completely attuned to any of those indicators. And I think part of that is led through the purpose of the organisation. I think, it's now 2021, right? So basically, are we all out to make money? Which I think is, the old kind of way around, you run businesses for shareholders, whereas now actually the change is, why do we run business? If it's not for the societal good, then what is the point? And I think we need to train our staff so they're fully educated, they understand what they're selling, but they also sell it as if they're selling it to someone who is their mother, their brother, their sister. So they have, it is a human. And there is an outcome, so I think you just need to be sort of driving those strong customer behaviours through highly skilled staff and with the right outcomes in mind.
And it's really interesting you talk about how debt is still shameful. I mean, Emma, that is part of the problem. A lot of customers don't seek help because they don't want to admit they're vulnerable. And so how do you change that?
Absolutely. I mean, I think it's a cultural point there, the shame around debt, the shame around admitting a vulnerability, or indeed that you're facing financial difficulty. And look, it's an issue and it's a difficulty for firms to have to get to grips with. The flip side, of course, is that as Lucy said, there's never been a more important time for firms to really ensure that their identification processes for vulnerability and difficulty are as embedded as they can be, and they are learning from market intelligence about where the trends of vulnerability are. So identification is key. And one part of that is the communication that you have with the customer. So empowering agents through training, as Lucy mentioned, to be able to ask the right questions, albeit sometimes the sensitive, difficult questions, and to have active listening, to hear what the customer's saying and be able to go down those tracks of teasing out where there might be potential vulnerabilities. So it's about empowering and giving representatives of firms who are at the coalface with customers that confidence to do so. But that also coupled with looking at customer behaviour and the rich source of data and MI that firms have available, whether it be customer complaints, customer feedback, looking at the algorithms behind customers, clicking into forms. Are they changing information all the time on their forms? Are they always looking at the FAQs and their stumbling blocks in the application process? All of which helps to build a picture of what the trends of vulnerability are, and therefore back into the training of staff to enable them to spot them at an earlier stage.
Yeah, and let me bring in Nigel, who's listening to this. Nigel, from your perspective, of course, as Lucy and Emma have been pointing out, it's all about communication with the customer. How can analytics help here, do you think, to tailor much more effectively communication to individuals and their situation?
Look, absolutely. I would say the thing that comes to my mind is early intervention, and we've got an early intervention strategy at HSBC that pulls in a full range of data sources. Put simply, someone just going into arrears is not a sign of financial difficulty. There are all kinds of oversights or errors that people make or may happen that push someone to miss a payment. But there are some really strong warning trends as well that come alongside it. So if you can see that propensity for a customer to go or higher risk of someone moving into late stage arrears, and then start building the communication. And we've mentioned it a few times already, but proactively flagging support that we've got, having the right tone around that and the right channels so that customers want to engage, can engage on the time and the sort of place and the means or the medium that suits them. But really just setting the tone and building the relationship so the customers know that we're here to help and we're not someone to run away from. I think, all too often we see that across the industry. The customers run away from lenders. Customers obviously can be over optimistic, can hide debt from their families, from relationships and things like that. But if we can get in there early, we can have that directed communication, then I think we can get that across to customers that it's a core part of our strategy, that we're here to help. And that then helps us very much when a customer does actually get into that financial difficulty, when they do start to miss payments.
But what should senior management be doing here to really ensure that the appropriate controls are in place, Nigel? Because there is a big onus on them, leadership from the top down.
Yeah, look, absolutely. I'd say two things. So one, really understanding the sort of end-to-end journeys and a real focus on customer outcomes, not doing it, you can do point-in-time QA, you can do all of the kind of checks that you want, but actually really following customer journeys through to see exactly what's happened to them and doing it in a sort of forensic, analytical way, I think is absolutely a must. And you must keep on top of that. You have to have the right sort of data sizes. You have to get fully into that fully end-to-end position. But alongside that, I would say the use of new technology and MI, measure what you can measure. Are the processes executed the way that you expected? Look for exceptions. Don't just wait for them to come out in poor customer outcomes. But really having senior managers that understand the journey, that understand the issues, that are close to the operations, and that can get the nuance and therefore can keep on top of it rather than sort of just chase numbers around for a governance point of view.
I can see Lucy nodding here. What more needs to be done then, do you think, in terms of senior management responsibility?
I agree with everything Nigel said. I think the key point for me is that the FCA is citing that sort of more than 50% of the population are considered vulnerable. Only 3% of that is identified by financial service providers. So I feel that there is just this huge delta between those two figures. And I just feel like evidently there is more that we need to do to really understand who our customers are, where that vulnerability may arise, and preparing them for that event as it happens, and making sure that we're there to support it and work through it in a proactive and constructive way. I think the one other point that I'd raise is that obviously we talk about data all the time, and there are services that look at categorization of vulnerable customers, but it's the one area where I feel that we need to be really, really careful, because vulnerability often manifests itself in poor credit. And so what you do not want is to have your most vulnerable members of society being overly priced on credit as a credit risk. And what you do not want to do is preclude them from certain banking tools that could be life-changing for them.
Okay, well, thank you very much for your insights so far. We've got some questions which have come through from the audience. Simon, can I ask you, how do you think organisations begin and follow through with the culture change that is really needed for a scenario that Lucy's been explaining, towards becoming a much more conscious business that recognises vulnerable customers? What do you think needs to take place before that culture change can be brought in?
That is a tricky question. So, I mean, we're a fintech. There's 70, 75 people, I think, within the business at the moment, and that's a very different beast, to the largest incumbent banks out there, even the challengers and the neos.
But from your point of view as a fintech, what do you think perhaps you can offer a different perspective, perhaps for those larger organisations that take much longer to turn around?
Yeah, so we're obviously much more agile. We're able to sort of pivot and offer different solutions, often very, very creative solutions. I mean, listening to what was said, so education is absolutely critical. Businesses still don't understand their funding options. They don't know where to go. The industry is hugely fragmented. So providing material in a very convenient way for business customers to be able to understand what options they can avail themselves of, I think is sort of step number one. We did some customer research, and one of the key things that came through from customers is they want somebody to give them hope. We've seen lots of different behaviours from lenders across the sector. Ultimately, what they want is somebody not to just give them that cold, hard no and then not help them at all. So what we try to do is we work with third-party partners to help get businesses credit ready if they've got issues. Again, help them educate themselves. Just do anything that you can to bring them on that journey to try and sort of reduce that vulnerability. The last 2 years in particular, I mean, let's not get started on the mental health topic, but vulnerability has always been there, but it's been exacerbated, I think, multiple-fold over the last 2 years. So anything that we can do to find a creative solution is only going to be to their benefit.
Okay, thanks very much. We have another question come through from our audience, and it is about customers. To support all customers and maintain that personal connection and trust that's crucial, especially in lending and mortgages, should the human touch always remain? Should certain elements never be automated? What do you think, Emma?
I think never is a very finite term, but I would say, or a definite term, I should say. I would say when you're dealing with the stickier end, so the vulnerability, the financial difficulty, from my perspective, there is no substitute for the human touch, and it's the human ability to empathise and ability to dig a little bit deeper than potentially AI and potentially data can, that I think really at that more difficult end where people need the absolute highest level of support, I don't think there's any substitute for the human element.
Do you agree, Lucy?
Yeah, I mean, 95% of our book is automated. We do not speak to our customers. We've probably never spoken to our customers or spoken to them once. And that's the way they like it. They've got their money, they repay it. It's a perfectly frictionless relationship, and they're really happy with that. So I think Emma's point is right. We should be focusing that contact on those customers where we believe they're more vulnerable, potentially those higher credit risks, to really give them the support they need to kind of thrive in the post-pandemic world.
Thank you very much. And just final question for Nigel. High focus leveraging of data and AI at the point of lending. This is what this question is focusing on. How can it be used to manage a customer well-being during the course of a loan or multiple loans and a changing customer financial situation? How do you see AI playing a role here, Nigel?
I think it's a very big question, isn't it? I'm going to skip the question a little bit, I think, because I'm really not sure what the role of AI comes into there. I think data definitely. So, and we talked about that. So having access to data that can give you early warnings of things, and I think you can then bring in maybe some AI and machine learning in order to sort of differentiate, categorize, and work on comm strategies that might suit that. But I think for me, the overall thing is just having the right engagement levels or openness with the customer, so that customers can contact you, so that you can contact customers if you think there's an issue, or you think there might be an issue, but also having product facilities available so that customers can change products or can ask for changes through the lifetime of a product, so that their products can be tailored to suit their circumstances. But where AI fits into that, I think it's an interesting one to speculate on. But for me, there's also the people that we do have as a well-trained, empathetic agents on the phones who can have those good conversations and really sort of probe into what's best for the customer.
Okay, human touch, always important. Well, thank you so much to Nigel and to Lucy and to Emma and to Simon. It's been a really, really fascinating discussion, but I'm afraid it is all we have time for.